First, we're going to start with the system, not spend that much time in the system, a little bit more time on the state, on what's going on in the state, and then spend the bulk of the time on what's going on here on this campus in terms of the finances, enrollment, trends in hiring, and all sorts of fun stuff. So overall, the system is doing well, as is the university. Strong reserves, strong cash flows, as we'll show you. And this is in the face of, as we will show you, a declining state appropriation. Now, the future's looking a little better. I think the numbers will show that there's been too much administrative spending and hiring. And that really takes away from what needs to happen here, which is be more devoted to the core mission. And we'll look at enrollment and tuition revenue and really focus on the out-of-state enrollment and some interesting data on that. So let me start, and bear with me because occasionally this thing makes me start over again. Don't ask why, just play along, and we'll be fine. It just kind of does this, and there we go. Okay, so this is the system itself, and it's 4 million on the left. In thousands, so you add 3 zeros. So that's 4 billion, and about 2.5 billion in liabilities, and net assets are the rest. What we're going to focus on is, at UO, what component of those net assets are reserves that's really available for free spending in terms of new initiatives, faculty hiring, lowering tuition, faculty salaries, and those things. The decline in assets from 11 to 12, a lot of it was paying off debt. You can see the red line coming down at the system level is paying off debt. And what we'll see when we look at UO, when we look at the same picture for UO, we'll see we're not going to see those downward arrows, those downward trends. We're going to see actually an upward trend in assets and even more of an upward trend in net assets. Basically, this is the system's not broke slide. And that's about all you'll learn. In terms of the system's reserves, the unrestricted and the restricted reserves are the things that money set aside for purposes such as debt repayment, scholarships, capital projects that have already been agreed to, and then unrestricted, suggesting more financial freedom and flexibility. And you can see the system's got well over $600 million. And we'll talk more about UO's reserves. So it's pretty strong in terms of their reserves. And this is all in the face of this, and that's the decline in the state appropriation. So we have 3 components to what the state gives OUS, and then OUS distributing to the 8 universities within it. The operating appropriation, the capital appropriation of the state, and then the red is the federal support. The ongoing federal support, this is not federal grants, as someone brought up earlier. This is not NSF grants or NIH grants. These are grants from the federal government, mostly Pell Grants, mostly in the form of Pell Grants. And you could see what happened in the bigger red bars in 9 and 10 are the federal stimulus that was signed into law in February of 2009. Seems like a lifetime ago. Is there going to be another federal stimulus? Of course not, because it's just not going to be. It's not going to happen. So if anything, the opposite would happen. But that's why those red bars were larger there. The blue bars, if you were able to compare the blue bars over time, really been a significant decline in the state operating appropriation at this level. We'll look later at how these blue bars look compared to other states. We'll look to see how Oregon's doing compared to other states. So this is going on. At the same time this is going on at the system level, we also see revenues going up, even though the system has declining state appropriation. And the other revenue sources, the big revenue source, of course, is tuition. And then grants and contracts, as we'll see, are increasing when we look at UO. So even in the face of a big decline from the state, we're seeing total revenues from the system increasing. What about next year, or the year we're in now? We're right now in the 12-13 year. What the system, they just had their meeting of their Committee on Finance Administration in February, just a couple of weeks back. They're predicting for the full year, the year that's going to end June 30th of 13, they're predicting a 6% increase in total revenues. That means this line will go up 6%. That's what that means. And where are they getting that from? Well, an 8% increase in tuition, rate increases, enrollment increase, and then a change in the mix of student enrollment. We're going to look here at UO. The change in the mix here has been out of state, has been the increase in out-of-state students, and we'll show you that. The other 5% increase, which was news to me, in the biennium, you know, everything is a biennium here. Everything's done 2 years, 9-11, and then 11-13 and 13-15 and all that. In the first year, you only get 49% from the state. The second year, you get 51%. So we're in the second year. 13 is the second year of the 11-13 biennium, so the state's going to get a tad more. So far this year, revenues are up 5, spending's up 4. So things are okay for this year. What about the next biennium? Well, the first two columns are what happened in 9/11, 2009 to 2011, and then 11 to 13. Just look at the total general fund. This is, again, for the entire system from the state. You could see a huge drop. And the way the money comes from the state, you could see it comes education in general, and then it has these other parts to it. The other parts didn't get touched. It's the operating appropriation, the main operating of the education in general, that really got hit from the 9/11 to the 11-13, from $633 million down to $486. Then nothing's been approved yet. The legislature and the governor. So the governor has put forth his proposal, and then this is what OUS is putting up based on Senate Bill 242. So they're pretty close to each other. You could see they're pretty close to each other. But the legislature has told the OUS administrators, what we need you to do is tell me how much a 5, 10, and 15% reduction would be off of this. 10% of 719, you guys with me on that? 0.1 times that, is that? Yes? Or is that too much math? Half of that is that, you see, it works out pretty well. And that's about 3 times that, see that? So now these haven't happened yet, and given what's happening, it's hard to say it's going to happen, but they're trying to say, in worst case, these are the things that could happen. And so that would mean further cuts from, so the 486 to 521, the thought is it may not happen. You could see, 486 to 521, well, that looks like about 35. Well, if it's a 5% reduction, that takes, if they decide a 5% reduction, then the appropriation would be flat. Flat appropriation sounds okay, but what's the problem with the flat appropriation? What do you have more of? Students. Have you guys noticed there's more kids here? No? No. There are more students here. If you can believe that, we'll show you that. What's going on unemployment here in the state of Oregon? These are the last 4 Decembers and the unemployment rate. Right now, Oregon has the 11th highest unemployment rate in the country. It was 7th highest just 2 years ago. It's 8.3% above the national average. No state is above 10, if you could believe that. It certainly was Rhode Island, and Rhode Island is number 1. The new numbers will come out. The state numbers are a little late. The new numbers are going to come out, I think, next week. We'll see the January numbers come out for the individual states. And it's hard to know if those numbers are going to come down. I still think, when you look historically, as I'll show you, these numbers are still fairly high. And we all want to be like North Dakota. The problem with North Dakota is there's no one who lives there, so of course they have a job. The one person has a job who lives there. These states historically, Virginia and Iowa, have lower unemployment. Having said that, these rates here, they're higher than they used to be. They're much higher than they used to be by historical standards. It's almost like the distribution has shifted 1 or 2% to the right from normal. Why, if we're recovering, if the economy is recovering, are these rates not coming down? Now, it is coming down, but not nearly as quickly as it did after the recessions we had in 1982, in 1991, in 2001. Those last several recessions, the unemployment rate came down at a faster rate than we're seeing here. And why is that a factor? Well, as we'll show you here in Oregon, there is no sales tax here. So the state is so dependent on people working in the income tax that it makes a big difference. This is Oregon versus the national unemployment rate. And you can see Oregon historically has been higher over the last 10 or 12 years, but not much. The trend, again, that downward slope in the last couple of years, it's not as steep as it has been in past recessions. And that's what we would like to see. And that's what the problem is. And there was a piece in the Times yesterday, I think it was yesterday, the day before the front page, how the Dow Jones is now at a record high. Firms have better balance sheets than they've ever had, but the hiring isn't there. Why isn't the hiring there? Why is that not going along with this better economic news? And that's hard to know. There's a lot of reasons for it, but it's disturbing that the slope is not coming down even further. But we'll see. What's your tax structure like in Oregon, and how does it compare to other states? Okay, this comes from 2013 Public Finance Basic Facts in the Oregon Legislative Revenue Office. Oregon, what this is saying, all this mess is saying, that for that 35 number, Oregon has the 35th highest total taxes per capita in the country. It means you're a low-tax state. That's why you all live here, because you knew this was a tax haven. It's like the Cayman Islands of America. That's why you all came here. The weather's the same also. I've been here, you guys know, this is my 5th time, and I have yet to see the sun in my 5 visits to Eugene. Does the sun ever shine here, honestly? Yeah, well, well, it would be nice once. It would be nice. All right, you have the 5th highest income taxes per capita. Sales taxes, though, that 47, you have no state sales tax. And the title of the slide, is there a sales tax in your future? That's not a rhetorical question. There is going to be a proposal in the state legislature this term that to have a 5% statewide sales tax. Now, some people think it has no chance of passing, but no one thought the surtax on income would pass either. And it did, and as I recall, it wasn't ridiculously close either when it passed. So things change. It seems unlikely it's going to happen right now, but I think it is pretty revealing. I bet most of you would not have thought this, that you guys are such a low-tax state because your income taxes are so high, but you don't pay any sales tax. Isn't that why everyone vacations here in Oregon? Yeah. Anyway, look here at the second bullet point. In 1989, Oregon had the 10th highest U.S. tax burden on a percentage of income basis and was 21st on a per capita basis. So you used to have a much higher burden compared to other states. Now, over time, it's become much lower. Most of these other states have increased their sales taxes considerably. Though the income tax increased some, it's still fairly graduated income tax. It's fairly low at the lower rates. So that's why you're a low-tax state. That doesn't mean, boom, we need a new sales tax, but it's certainly being discussed and considered, and these kind of figures, I think, are being thrown about in the legislature. What about the revenue forecast? This is from a news article a couple weeks ago, and the legislative office has all sorts of data on predicting revenue, and they are predicting, basically the second bullet point is saying we're predicting a 1% increase in income tax revenue for 13-15 based on what we had before. So we actually think things are going to get better. 87 million over 16.6 billion. So the general fund is 16 billion, and they're projecting an 87 million increase, which isn't that big percentage-wise, but still, they talk about housing, market growing, strengthening the business services, healthcare, and education fields. But still, income is not back to where it was back in 2007, 2008, and job growth in some major industries is still not recovering. If the latest projections hold true, this 11-13 revenue increase won't be big enough to trigger. You guys know about the triggers here. The triggers are simple. If the tax revenue to the state goes up a lot, you all get all your money back. Everyone gets everything back, and everyone goes on vacation forever. The triggers are designed to make sure that the legislature doesn't spend any extra tax revenue they get. If tax revenues come in bigger than expected, the idea is give it back to the citizens and don't spend it because there are no needs here. Because obviously there's no needs in education or health or anything else in the state, so there's no reason to spend it. So give it all back. But I think the point is the small revenue increases that are being predicted will not lead to this trigger. And by the way, there's also a proposal in the legislature to do away with the trigger, to have the trigger eliminated, that if there is surplus, that it go into a rainy day fund or go into the needs I just suggested, education, healthcare, et cetera. Some other things that have come out of your legislature, Senate Bill 242, changing OUS from a state agency to a public university system. It's hoped that this will make legal decisions more efficient, as if they could be, save money. Now, there is a review of healthcare and retirement plans that all of you pay, that all of you are on right now. And the idea was we're going to move you from one system to another. Right now, they're saying for the foreseeable future, we're not moving you. It doesn't mean you don't have to pay anything. You're still going to pay what you're paying in terms of your premiums, your co-insurance, your deductibles. Those are still going to be in play. But there's not going to be any major changes in your health care or retirement in the near future from what we see right now. And then the legislature came up with this idea that by 2025, 40% of adult Oregonians are going to have an associate degree and 40% are going to have a bachelor's degree or more. And then 20% are just going to have a high school diploma. How is this going to happen? Well, it's not. I can tell you that. It's not going to happen. Right now, 29.2% of adult Oregonians have a bachelor's degree or higher. How do you get from 29 to 40? This data doesn't move like that. This data moves 0.1 per year if things go well. It doesn't go from 29 to 40 in a 10-year period. It's not possible for it to move that quickly, especially given the level of state appropriation, which we'll look at compared to other states. So Oregon is ranked fairly high, 18th in bachelor's degrees or advanced degrees or more, and even higher in the percent that have a high school diploma or more. But right now, Massachusetts is highest at 38.2. It's hard to see how, and it would be nice if 29 got higher, but it's going to take a commitment of resources that right now isn't there. So now we're going to shift everything here. Everything right back, everything from now on is going to be, we're going to shift with a little detour to those state appropriation numbers to this campus. And this is the UO balance sheet. And you can see it looks a little better than the system as a whole. You can see the assets going up even from 11 to 12, liabilities down, and you see the net assets going up. So we have about $600 million in change in net assets. So we're going to answer the question, of that $600 million in change, how much are real reserves that the university has? Well, there's two components of reserves that I have here. If you look at the top bar, the two together, what I call unrestricted and restricted, which we'll define in a second, are $200 million. Well, what gives? On the slide before, we had total net assets of, if I can get there, $600 million. Where's that other $400 million? The other $400 million in net assets are in the buildings. They're in all the physical buildings on this campus. And these buildings, they're worth something, but are they going to sell this building? Are they going to sell all these buildings? Why can't they sell the buildings? We need to teach students. So as long as the buildings won't be sold, as long as they're not going to sell the buildings, that $400 million in net assets tells us nothing about the university's financial health or flexibility. It really tells us nothing about the reserves of the institution as to what they could spend freely on or what they have some discretion over. So what we're left is these two components, the restricted and the unrestricted. And the way I describe restricted, again, it's money set aside for future scholarships. If there's a future building where a contract has been signed and it costs money to build that building, that money is going to be in the restricted fund. It's also going to be to pay off future debt service if there's been borrowing from Oregon, from the University of Oregon, that OUS has charged to this university, paying back that debt gets in there. So why count it? If it can't be spent on faculty salaries, why count it? Well, I'll say this. The bond rating agencies, everyone who looks at reserves definitively counts this. And the simple reason is this. And the example I give is if you own a home and you have a mortgage on your house. Let's say you own a home with a mortgage. And you're fortunate enough, for whatever reason, to have in a fund every dollar of future principal and interest on this house set aside to pay for your future principal and interest on your house. The rules are simple. You can't touch the fund for anything but to pay for the house. If someone gets sick, if someone has a health care need, can't touch it. Are you better off having that fund? Of course you're better off. You don't have to pay any of your current income to make your house payments. Wouldn't it be nice if all of you had your house payments totally taken care of and all you had your current income was to spend on going out to eat, which is very expensive here in Eugene, from what I'm told. So that's why it's included. But in terms of real freedom, what we really look at are these unrestricted reserves, which is about $100 million. Now, does that mean there's $100 million sitting in a thing of cash in the president's office? No, it doesn't mean that. It means that they have financial freedom and flexibility within this $100 million. Now, is some of that committed? What the university will likely say, if they see this presentation, what they'll say is, he doesn't get it. He thinks that that $100 million is free, but we've already committed some of it. Well, here's the deal on that. If they've committed some of this $100 million to a future academic program or to a future capital project, if it is a firm commitment that they can't get out of no matter what, no way they can get out of it, the auditors, the external auditors, wouldn't put it here. They'd put it in the orange. They wouldn't put it in the green. So they may have commitments to say, we're going to put 10 million into this and 20 million of that into that, but it's not firm. No way can you get out of it. No way you can't get out of it. So therefore, this does represent financial freedom and flexibility. Does that mean they should go out and spend $100 million? Absolutely not. There's a level of reserves which you want to keep, which is basically a percentage of your annual expenses. This place should keep conservatively 15 million, maybe 20 million if they want to be really, really prudent. They want to keep at least this. And if they want to be super, super prudent, they could keep up here. But they still have, conservatively, $60 to $70 million. Yes?
Howard, is the increase from 2009 to 2012 was $70 million? Is that attributed to increase in student tuition?
Well, there's several reasons why that increased. Number one is what you just said. Tuition revenue, as I'll show you, went up significantly over this time, more than overcoming the decline in the state appropriation. That's number one. Number two, the second reason, along with that was happening, your salaries didn't increase. You guys notice that? And so, but it's not just the salaries not increasing. There was not necessarily a hiring freeze. I would say there was a hiring slowdown. So when people left, they weren't always replaced. There wasn't a freeze because every year around here, from what I'm told, every year I come back, there are searches going on, and there are searches going on now. There are faculties, but they're not full-blown searches the way they have been in years past. So combine the tuition increase. You have an increase in enrollment, as I'll show you. Nathan will show you the increase in enrollment combined with the tuition price increase has really led to a significant increase in tuition revenue, more than overcoming the state appropriation decline. And combine that with not giving you guys raises and not replacing all the faculty when they leave, what you're left with is surplus, which is leading to the increase in enrollment. Now, I think, let me, if I'm an administrator, imagine that, put myself back in their shoes in 2009, in 2008, 2009. The world is, no one knew what was going on then, right? Things were really bad. Everything was falling apart. So reserves were down to 29 million, right about as little as you would want them to be. So what they said, okay, what we have to do now is we have to tighten our belts, no raises, slow down hiring, and jack up tuition. I'm paraphrasing, but that's about what they did. Now, the issue I have with that is did they have to do it for the last 3-4 years in a row? And that's what seems to have happened. That's why you see the unrestricted reserves going up every year. Because as you all know, there hasn't been a real large amount of faculty hiring, and there were some, as I'll show you, there were some raises from 11 to 12. The reason this did not grow as much from here to here as it did from here to here, there was significant raises given out last year. Now, I've heard a lot of terms. They were whispered, they were secret. I think someone used the word secret. Whatever words they were. But I'll show you, we see these raises in the faculty salary data. We'll see it. And so that's why the reserves did not quite grow as strongly from 11 to 12 as they did from 10 to 11. And they grew pretty strongly from 9 to 10. So that's really the big picture. And it takes us right to the next, 2 slides from now. This is an aside. This has nothing to do with any of that. The foundation is completely divorced from any of the stuff I've shown you. So none of the reserves, this is people giving money to the foundation. The university can't use this foundation to pay faculty salaries. They can use some of the income from the foundation to pay for certain student scholarships and other educational needs, but they cannot. They cannot use it for faculty salaries, and they don't. But it's still nice to have $800 million lying around just for the hell of it. And the way it works is roughly 5% of it gets 5% of the $800 million gets given to various scholarships. You could see the endowment lost quite a bit, the foundation lost quite a bit of money from 8 to 9 because of the stock market decline, and it has done a little better since. So this is complete, everything I'm showing you has nothing to do with this foundation, completely divorced from it. So here's the slide, and let me spend a couple minutes here. I have two different constructs here. I have the change in net assets and operational cash flows. The change in net assets is revenues minus expenses. It's total revenues minus total expenses on what we accountants call the accrual basis. What is the accrual basis? It means not cash. It means if a student says they're going to come here and they get billed tuition, but they don't, and they come here and they don't pay the tuition, we still count that as revenue. It means if the state says they're going to give you an appropriation this month and they're late paying it, we still count it as a revenue. It means if we have an expense for depreciation, the estimate of the wear and tear on the decline in value of our buildings, we count that as an expense. So non-cash revenues and non-cash expenses count in the purple. In addition, the university outside of the foundation has investments because they've generated money internally and they invest money. The paper gains and losses on those investments are in the purple. What are paper gains and losses? You have a portfolio, you have a bunch of stocks, you don't sell them. They go up in value, it's a paper gain. They go down in value, it's a paper loss. You could see 8 and 9 didn't look so good because we had a lot of paper losses. 10, the best year in the stock market by far was 10. And so you see a lot of bounciness, which is a technical term for standard deviation or variation, in changing in assets. What's more relevant to the strength of this university are the operational cash flows. What are the operational cash flows? All the cash from student tuition, all the cash from the state appropriation, all the cash from the grants and contracts, less paying everybody's salary, paying all the vendors, paying everything. So all the cash in versus all the cash out, with two exceptions. The debt payments, the payments for debt principal and the payment for debt interest. We typically don't count those. So, but still, if we look at this, we're looking at about $55 million for the last 2 years. The net debt principal interest payments, and the state actually gives the university some money to help cover those. But about half of the green gets eaten up with principal and interest payments on the debt. So you're still left with $25 to $30 million of extra cash flow the last 2 years that this university generates. That's not, and it's starting from zero. Yes?
How are grant monies counted? I mean, for example, NIH support.
Okay, let's say you get a grant. Here's the way grant money works. If there's an NIH grant, the university collects all the money from that grant. It's counted as a cash inflow. Then the grant says you have to spend your money the following way. You have to spend your money on equipment. You have to spend your money on graduate assistants, faculty salaries, travel. All that money is a cash out. The indirect cost that the university gets to keep, that in essence is extra cash on the grant. They are, like I said this before, I could give you guys a whole seminar on grant accounting. The bottom line is this: they make money on an NIH grant. How much money? It depends. It really depends on the grant itself. It depends on the field it's in. In some of the heavier scientific fields, they may make a little less. I think they make a little more in ones that don't have as much equipment associated with them. But still, part of this green, as I'll show you when we look at the income, we'll look in a second at the, we're going to look at the revenue distribution. We'll see how important grants are to this university because they're the second largest revenue source. Grant revenue is larger than the state appropriation here at University of Oregon by a lot. More than double, if you could believe it. So it's that important to this university. But it's so if you ask me, the two things as to why I think this university is in strong financial condition, I would point to, one, these green bars, the annual positive cash flows. The other thing I would point to is these green bars, the unrestricted reserves. So these two things, the unrestricted reserves and the strong cash flows, that's why I concluded this university, that not just the system, this university is in such strong condition. Yes?
You've expressed these in absolutes, but as a percent of revenue, how do we do compare to other universities?
Well, what I haven't done here, that's a good question. What I haven't done here is I give a full ratio analysis. So what we do is we compare. So what we do, we have something called the cash flow ratio. We take this and divide it by revenue. And so the rule of thumb is anything bigger than 5% is big. And I could tell you, let's just say, in general, this is about a $700 million a year operation here. A little less. Back in 12, it was a little less. But let's just say $700 million. So if I take about 50-something million and divide it by 700 million, that's about a 7-8% cash flow ratio. Anything bigger than 5% is considered very high. Okay. So that cash flow ratio this cash flow ratio here is very high. We also consider reserves compared to total expenses. So the reason I don't do a full ratio analysis here, you guys can't get debt on your own. The university here cannot go to the bond, can't go to New York and get money on your own. Everything you have to do is through the states, is through the system. But still, we compare, to see if this is big, we compare it to total revenues, anything bigger than 5%, and you're about 7, 8% consistently. Now, let's take the question on grants. This is the 2012 revenue distribution. Where does all the money come from? And obviously tuition, two of the questions mentioned the two biggest sources, which obviously means you guys are, I put this stuff up here. You guys know all this. You guys really, I don't think I'm telling you anything that, you know all this. I'm just giving you more detail on it, but you guys know all this stuff. You knew how important grants were to this university. You knew that tuition is it. Tuition, you're almost private schoolish. Now, I'm going to be in San Diego this week, and we're going to look at a lot of private schools in California. Private schools have about 80 to 90% of their revenue come from tuition and auxiliaries. You guys aren't like that for a couple of reasons. One, you've got huge grants compared to most private schools. These are grants written by faculty. They're mostly federal. There are some state and local grants in here, but this is mostly federal grants that faculty are writing. And the university, so now a lot of this is money in, money out, as you were saying. A lot of it is the money comes in and the money goes out, but there is certainly profit that they're making through indirect costs. The auxiliaries, housing, dining, student union, typically athletics is built in there as well. And look at the blue. The state appropriation. It's tiny. It doesn't mean it's irrelevant, but when the administration starts making noise that the state appropriation is down, so we're in trouble, take it with a grain of salt. Now, let me say this. When the administration makes a pie chart on your revenues, what they do is they take this and throw it out. They say they don't count. Grants don't count. And they take auxiliaries and they throw them out, and they're basically left with just those couple of things above. When you do that, yeah, of course, tuition in the state are a lot more. But to suggest that grant revenue on auxiliaries don't matter, they do matter. Yes, and it's true. A lot of the auxiliaries, a lot of that revenue gets directly paid for because these students live here, right? You got to make sure they're not killing each other, right? So you have to hire a bunch of people to watch them so they don't do bad things to each other. You have to feed them. I mean, in dining, you have to actually buy food to actually feed them. I don't know what the food is like here, but it costs something to do that. So my point is, these two slices of revenue have a lot of direct expenses associated with them, if you know what I'm saying. But so does everything else here. So to me, when you look at the university, it is one university. It's not University of Oregon Education and General Fund only. It's one university. And if they're generating profits from auxiliaries or from grants and contracts, then those resources can be used for the academic side. Now, I was talking to a student earlier today. He was telling me that in every class, almost every class he's in at the beginning of the semester, they have to sit in the hallway. They have to sit in the middle of the class, and there aren't enough seats. Do you guys notice that class size is a problem around here? Yeah. Well, maybe they could do something about that, as I'll suggest. Maybe something could be done about class size. Well, obviously, you're limited by physical space, but you actually could run more sections of things, if you could imagine that. And the way you run more sections is you hire more people who actually teach class. And we'll show you how that could be done. But this gives you a sense of the overall university and what's going on in terms of revenue.
Just a quick follow-up on this. The subsidy from the foundation, I don't see it here. Is it one of
the subsidies from the foundation is very small. It's probably buried in other, because you think about it, 800 million,
yeah. 5% 800 million is 40 million.
Yeah, but a lot of that, that's a revenue and an expense because it comes as it comes in and they spend it as a scholarship, or sometimes they don't even count it as a separate. Private schools count it. Public schools typically don't even count it. Private schools count it. Private schools have a separate line that says amount allocated for operations. Public schools don't do that. Publics don't do that. So here you see the problem over time, which we all bemoan. And this is just in pure dollars, the relationship between tuition money and state appropriation money. As bad as it was through the middle part of this last decade, it's really been exacerbated in the last couple of years as the state has really declined in what they're giving. Plus, we've seen with tuition, as I'll show you in a second with tuition, what we've seen is, as I said earlier, not just an enrollment increase, but significant price increases, plus significant mix increases in out-of-state students. You put all those three things in the pot. More students, higher prices, more out-of-state students. What you get is more and more tuition revenue. So, but still, I think we all share, all of us, no matter what our political persuasions, no matter our view on bargaining or negotiations or anything, we all share the belief that that is not acceptable, that the state itself is not supporting higher education to the way it should, and we'll see that when we look at the other states. But this graph is pretty damning for them. Now, here's the comparison to the other states. Just bear with me a second as I get in and out. And the data I'm about to show you came from a report yesterday from the State Higher Education Executive Offices, known as SHEO. Here we are. And so what I have here is from this report, again, it came out yesterday, March 5th, 2013. So what I've done here, I've looked at three variables: the state appropriation per student, the state appropriation per capita, and the state appropriation per $1,000 of personal income. And so the bars represent Oregon as a percentage of the United States average. So the appropriation in Oregon is 68% of the average for all the other states. Per capita, you can see it's a little less than 80%, and per cap on an income basis, it's between 80 and 85%. And these are the ranks. You rank 31st in appropriation per thousand of capita income, 37th in per capita, and 46th in appropriation per student. And the other thing that I don't have in this chart, the other thing is it's gotten worse. Over the last 5 years, that 46 was only about 39, and it's gotten worse in the last 5 years. So not only is Oregon giving less per student compared to almost every other state, but the trend is bad. Plus, what I have there in the yellowish box, if Oregon spent the U.S. average, then the operating appropriation right now to this university, not to the system, to this university is $45 million. The operating appropriation would increase by $30 million if this university got what an average student got around the country from the state in terms of the appropriation. So it's pretty sad. I think the legislature knows this. Either they know it and don't care, or they don't know it and need to be alerted to it. I don't know where you think they stand. Yes?
Can you go back to the other slide, that one just before that one? So, for the last 10 years or more, the administration has always been crying wolf about the fact that the state appropriations have gone in the tank. And if you look at that graph, there's some truth to that. Okay, from a high in 2008-9, went down maybe...
It's like 45, that's below 50 million now.
Okay, so it went down, 25, 30 million. But there was an increase in over 100 million in tuition and fees. So that raises the question of where did all that money get spent?
Well, it didn't necessarily get spent. I don't think a lot of it got spent. I think a lot of it's sitting in reserves.
Right, but are you going to go into expenditures?
Yeah, yeah. We're going to see that. We're going to look at all the expenses here on this campus. We're going to look at all the expenses individually over time. We're going to look at them closely. But this is about this is roughly the 45 million operating appropriation now, and that's a tuition revenue now. And by the way, that's tuition net of whatever discounts you give. So this is not very helpful. Now, right on cue, here are the expenses. So what I have here, these are the different expenses as a percentage of the total. Using the audit, and I got 5 years of data here. The core academic mission are the first two, instruction and research. You can see that percentage has been relatively constant. You would like it to be higher. The percent spent on research has gone down a little bit. The orangey, or whatever color that is, that's not orange, that's, I don't know. Whatever color that is, I can't tell. The public service, academic support, student services, those are all they have a lot of administration functions. This one here is pure upper level administration, institutional support. Your vice presidents, your president's office, provost, and all the very high level administrators who work here. The legal department would be in there, and all the stuff that they get involved in. So this just gives you, if you just look at this, gives you a sense of how things have moved over time. I don't see a tremendous amount of movement over time in the distribution. The distribution in 2012 doesn't look drastically different from the distribution in 2008. However, that doesn't mean it's right. Okay, that doesn't mean it's right. This, to me, that 30% and 10%, can't they spend at least half? Can't they spend at least 50% on the core academic mission here? Understanding that there's a lot of other stuff that has
What's
to
the
happen.
benchmark from another university?
Yeah. Well, when we, if we looked at it, there's no doubt if you looked at AAU universities or any of the others, these two numbers together would be lower. The 40% is going to be much lower than other places. No one really hits 50, but most of them are going to be 45, 46, 47. You guys are at 40, 41-ish. Yeah, 41, 60, maybe even 42. Most of them will be 45, 46, 47, if you add research and instruction. The UC system, University of California system's in the mid-40s. They even have a bigger research. UC system has only instruction in the 20s, but they have research close to 20 in the UC system. But that's also affected by they have medical schools there. You guys don't have a medical school here. And when we take out the medical school, still the UC system, which is, I think, is something you guys like to compare yourselves to, because I think for a lot of the students that you're now getting, those students were considering going to a UC school. And if you took the first two bars, the first two rows at the UC system, you would see they're combined higher than they are here. And this especially is a tad higher than it should be. And IPEDS, which I'll show you, IPEDS is something called the Integrated Post-Secondary Education Data System. They have something called the Data Feedback Report, where they compare you to their group of comparables, not the same group of peers that you guys use, but they have a peer group, and they show you exactly how much your spending is in all these categories versus their peers as on a per student and on a percentage basis. And if you guys want to bother me, I have it right up here if you guys want to look after we're done. And I think you'll see that you guys don't fare so well. Too much here, too little up there, I think is the bottom line. And we'll see that again in the numbers. Now looking at, this is the percentage change in these expenses over a 5-year period. Now when I put this exact slide up here last year, and I had from 8 to 11. Now, what's happened in the last year, the red bar, instruction, last year it was down here. They put a lot more money into instruction in 2012. And a lot of that, as we'll see, came in the form of increased salaries. And we'll see that when we look at the AAUP salary survey. We'll see significant increases in the average full professor and associate professor salary from 2011 to 2012. And we'll see that. And so that's why instruction is not as low as it was when I showed you this exact slide last year. But still, institutional support, of course, is higher. They have to pay their administrators more than everybody. They just can't help themselves. Housing, dining, probably athletics. Academic support is mostly your deans, associate deans. It typically includes the advising function as well, all the advisors and everything associated with them. So, but the money is in the dean's offices and all the money they're responsible for in academic support. Institutional support is just your vice presidents.
Yeah, so can I say it is essentially institutional support is university level administrators and academic support is college level administrators?
Yes, that's fair to say. That's a fair way to put it. By the way, at the back of this presentation, I'll just show you quickly, I have definitions on all the categories. So you can see exactly what's supposed to be in them. Now, I can't promise that that's what they put in them. That's what's supposed to be in them. So this here looks at a longer term. I got this data from the Office of Institutional Research, and I said this morning, I'll say it here again. As an outsider, as someone doing research in this stuff, when I go to your Office of Institutional Research, I'm able to find data much more readily and easily than I am at almost any place I go to. So anyone who anyone who works there, give them a pat on the back. You probably don't know them because they're probably a bunch of accountants, but they're pretty good in terms of what they. So from my perspective, I didn't have to ask anyone here, where do I get this? Where do I get that? Everything is there on that website for me to find. Which is nice. Plus, and this is on that website, which typically looks at enrollment and employee trends and things of that nature. On that website, they have this financial information. So those people who work there are also looking at the audited financial statements, which I think is not all the people who look at this office typically do that. They typically are much more, let's just say, what word I want to use? They work for the provost typically, so they do what the provost wants. These guys may have a little more independence. Plus, I've come here a couple of years now. You guys seem to have a lot of different provosts. Am I making that up, or is that true? Yeah, you've had more than one provost in the last 5 years I've been coming here. I know that. Yeah. So good luck to you. You guys have a search going for a new one, or?
Just starting.
Just starting. All right, well, the other thing I hope about that is you have faculty representation on the search committee, that the faculty decide who gets on there. We'll leave that for another day. But still, looking at a very long time series, institutional support wins by a lot. By the way, general rule of thumb, 100% is doubling, 200% is tripling, 300% is quadrupling, for whatever that's worth, not much. Okay. Shift a little to iPads. Again, what I'm trying to do here is give more detail on the expenses, on the main expenses, and what makes them up. So iPads, the downside of iPads, it comes from it's what they report to the feds. The downside is I lose a year because the 2012 data has not been reported yet by iPads. Though the university has it, they haven't reported it yet, and they don't have to. They're not being late. It's not due until April. So even within instruction, you could see within instructional expenses, yeah, there's salaries and there's benefits, but there's also plant, depreciation, interest that didn't used to be, but now they've added all that stuff. And you could see I did the percentage change from 2005 to 2011. So salaries went up 45% over that time. The total went up 78%. The dreaded other went up 91%. What is other? I have no idea what other is either. What could it be? It could be informational technology costs. Maybe they charge students a technology fee here. Yes? No?
Some colleges do.
So it could be that. It could be consultants. Maybe they bring in consultants to help them administrate because there's not enough administrators, so they need consultants to come in and help them. That was a joke. No one's laughing. Are you guys that bitter and sour? Really, what's happened here? You guys, I understand the weather sucks, and I understand we're in the middle of bargaining, and it's a tough time, but you got to laugh a little bit, don't you have to? No? Maybe you could say if I was funny, you would laugh. That's what you should say. Anyway.
Well, actually, can I just, speaking of gallows humor, so you've got several categories up there that were zeros in 05 and substantial numbers in 2011. Can I take it, this is boldly an accounting question, can I take it that they have changed their definition so as to incorporate more expense categories into instruction?
Exactly.
And can I, as a cynic, say that they're using an unusually generous definition?
I wouldn't blame the university. I think all the universities changed their accounting. Some were slower to the table than these guys were here, but they want to show as much in instruction as possible. So they were very happy when iPad said, go ahead, include basically anything. Include basically the lights in this, the cost to light this building, let's put it in there.
So this is an iPad definitional change, not a university change.
Exactly right. And so what I do with this data, because of what you're bringing up, when I look at iPad's data, what I do is when I look at it over a long period of time, I just compare the salary data. Even look at the benefits data. Just take a peek. There's no way that benefits should be more than half of salaries. Benefits, general rule of thumb, they're typically about 30%, something like that. So they often put stuff in there where they don't know where to put it. If there are extra buyouts, if people take an early retirement, they often throw them in benefits. So it's not even good. It's not even totally kosher. Can I use that word? Is it a Jewish holiday around here? I'm trying to think. Don't we have Purim coming up or something like that? What's that? I missed Purim? Damn. Passover's in March this year, so it's Passover. There we go. Okay, so Passover coming up. Anyway. That's not right. That's just too high. There's no way benefit rate should be that high. So as I'll show you, when I do iPad's data, what I do is they can't mess with salaries. Salaries is salaries. It's just pure ongoing salaries. So that's what we use in iPads to compare. And having said that, what I did just to be conservative, what I did was look at 2011, all the instructional salaries. It's everybody who's teaching a class. Add in the benefits related to those people, the total expenses for the entire university, almost a $700 million a year operation. So total salaries and benefits of everyone who teaches are barely a quarter of the whole thing. Everybody would think it would be higher than that. The university does other things besides pay people to teach class. apparently. Now,
In a lean organization, what would you expect frontline salaries to be as a percentage of the total?
well, here we go.
I'm a shell.
Okay. Well, here we are. So you may have seen this presentation before. And by the way, I promise you, I did not have this data last year. If I was going to come here, if I was going to come across the country, I might as well give you guys some new stuff, right? So now what this is everybody who works here. No, don't take no instruction. Everybody who works here, what is their salaries? And to answer your question, the general rule of thumb at a university is it's 2/3. 2 of every $3 goes to pay people. That's the general rule of
All salaries, not just frontline instructional salaries.
all salaries. Okay. Frontline instructional, unfortunately, is the 25/7 at UO is right in the middle of what most places are at, which is unfortunate, by the way. It's just the way it is.
Yeah, we manage, frankly.
Yeah. So what this is, so I took all the salaries, all the benefits, added them together, just to do some math. 288 and 147. If you could do some quick math, that comes to 435. Every expense here, so it's 63.5% of expenses. Look at the trend over time. This is more, we had 4 years in a row where it was in the 65-ish range. And then, boom, a 2% drop is a huge number. 2% on 600 million is 12 million, it's 10, 12, $13 million, somewhere in there. That's a lot of money. That's more money than we're arguing about at the table. If you know what I'm saying. That's way more money than will ever be apart, is this drop. What's interesting is this percentage has not rebounded. Now, when I do 12, I think this is going to inch up to 64 because of the raises I'm going to show you in the faculty salaries. I think this will be at 64. But they still have, the reason they're able to send out the memo they sent out the other day, they've got it. First of all, we know they have it in the reserves, and we know they're generating cash-wise. Plus, they know this. They know this either explicitly or implicitly. They know this is what they typically paid. Okay, things really went crazy, as I said before. Things went nuts in 2009. No one knew what was going on, right? And so the response was, again, no raises, easing on the hiring. So that's what happened. And they were able to generate cash flows from it. And they said, ooh, we like those. Let's keep doing it. And so they kept doing it. Have you guys noticed any big raises that you've gotten in the last couple of years? The reason you haven't noticed it, they kind of like the cash flows. And when they gave out these secret raises last year, it's not like there was a one-time influx of money. They've had it all along. They've been generating it every year for the last several years. Those green bars in the cash flows, they're generating $50 to $60 million in operating cash flow every year. They have it because they decided to pay people less. And again, it's hard to criticize. If you were an administrator in 2009 and you thought the whole world was going upside down, you probably would have said, we need to have a hiring freeze and we're not going to increase anyone's salary. You probably would have made the same decision. The problem I have, you shouldn't be making that decision for 2011, 12, and 13. You don't have to keep making that decision. It's not right. There's not enough going to the core mission. So this tells us that there's a lot of slack or reserves in what they're doing. Now, I got to go one. Sorry about this. Don't blame Apple. I blame the old projectors. My guess is that projector was not born yesterday. And here we go. So this is, by the way, we're on our way. We're going to get out of here, no problem. Upper level administration. First, what you see is 62%. Salaries of upper level administrators have gone up 62% in this time period. Pure salaries, again, in the instruction, they've only gone up 45%. I don't care what else is going on. Why are administrative salaries going up so much more than instructional salaries? Is that right? Let me give you another hint. When you give an upper-level administrator a 3% raise, that costs more than if you give a faculty member a 3% raise. Why? They make more. 3% of 200,000 is more than 3% of 70,000, last time I looked. So that's really what's been going on a lot. And the other category, someone this afternoon said this is all lawyers' fees. I don't know about that. That's not fair. I guarantee you the outside lawyers are in there. There's no doubt, but that's a lot of outside lawyering. Loitering or lawyering, I don't know which I said. Anyway, it's gone up by a factor of more than 4. So, all right. When I look at just the salary component from 5 to 11 in iPads, you can see auxiliary salary has gone up the most. Probably athletic salaries are driving that. And it's the average athletic salary, so even if you take the head football coach. But by the way, the head football coaches, the way the salaries are for football, they don't have like $5 million salaries in the books. The salaries are much lower. And then they get paid from different funds, et cetera. So you're not going to find a head football coach making millions and millions of dollars, even though that's what they may take home when all is said and done. But that's not the general fund-based salary that you're going to see. It's only, my guess is it's only probably a couple $100,000 out of the general fund. I'm not saying you should feel badly or not badly. I was told today you guys were number 2 in the country. I can't, as a New Yorker, I just cannot get my hands around college football. I just can't. But I don't know. What was that? Yeah. I'm just worried. I'm just hoping Carmelo Anthony's healthy. That's all I'm worried about, right? No one knows who he is? No. Anyway. Upper level administration, number 2. Instruction, down here. Okay, here's where I've been talking about the salaries. Now, this comes from the AAUP salary survey. When I came to you last year, I only had the 2011 salary survey. Now we have the 2012 salary survey. And things changed considerably in the last salary survey for U of O, and I'll show you why. First, the bad news. From this group, you're last at all 3 levels, 5th out of 7 on the instructor level. If you recall, 2 years ago, you guys got all mad at me because I brought all 33 AAU schools, and you guys were at the bottom, and you got all depressed. You started throwing things at me. I said, okay, I'm not going to bring that anymore. I'll bring a smaller peer group, so you won't be as bad. It won't be as bad to be 33rd. It will only be 9th. You can say you're 9th instead of your 33rd. I don't know what the right peer group is, whether it's AAU group, like I said, that has 34, or this is the right peer group. There's another peer group on there there's an aspirational peer group that puts you even worse. I didn't use that because, I don't know, Columbia was on there. Not that Columbia's a great school, but I just don't see it. I don't see that as, I don't know, they're private school. It just didn't make sense. Anyway, so you're last. Average full professor is 112. The average of the group, I took the average of the ones without U of O is 134. So 112 versus 134, you're 22,000 behind, and the average full is 22 behind. The average assistant's 11 behind. The average associate's 11 behind. The average assistant's 5, and the average instructor's 11 behind. Now, when I look at the period from 06 or 05, 06 to 10, 11, the full professors in that time period lost 1679. The associates and the assistants gained in that time period, and the instructors gained. They're still way behind, but they gained. Now, if I just, the very last row here has what happened from 11 to 12. The average full professor gained 2,752 versus the peers. That's actually a pretty big gain if you think about it, because it's your increase versus the average for everyone else. It's not like they got increases too, but your increases were much larger. And you could call them secret raises, you could call them, I don't know what you call them. But basically, they went from 106 and change to 112 and change. The average full professor got a $6,000 raise last year. Now, I understand that not all, if you're a full professor, I know a lot of you didn't get $6,000 raises. Some of you got more, though. The average assistant also did well. Gained 1170, the average associate, gained 1179 versus the peers. So the point is, this negative 22.7 was like negative 25 when I was here last year, if you know what I'm saying. And now it's gotten better. So there is some good news here. Now, the average assistant actually lost ground, and the instructors lost even more ground. I would say that tells me that these these secret bonuses did not get evenly distributed throughout the instructional ranks. They seem to be centered more towards the higher ranks. You guys are all shaking your heads, yes. So again, I'm not telling you anything you didn't already know. I'm just showing it to you explicitly. And so the story that I'm telling you is a story you all know, but now you see it. You may not like to see it, you may be pissed off about it, but I'm here to tell you what is. You guys are going to decide what to do about it. Yes?
I think a point here, and maybe this is, is that to some degree, that kind of strategic, whether you call it secret or not, salary boost is what we really need if we're going to ever aspire to be close to get out of the 9 out of 9. Right? I mean, it's that kind of move that is what's going to be necessary.
I would suggest, I completely agree with what you're saying. I would suggest that there has to be some strategy to get from here to somewhere in their general neighborhood. It would be nice if there was some plan to get there. It would help if there was some plan to get there. It seems like the plan that they used, though, was we're going to give raises to our favorites. Is that too strong a word? Okay, to selected. How about this? To selected people. I think it's more fair to give it out based on everyone has a chance to get them. Everyone knows what the rules are. If part of it is merit, okay, if that's what you agree to, but at least everyone knows what the rules are going in. And this is also disturbing, is that these things were not evenly distributed, and the less you made, the worse you did. Yeah, Scott.
Sorry, I've now seen this slide 3 times, and it took that many times for this to jump out at me. Instructors at UNC make
Well, here, let me tell you the problem with some of the data. The instructor categories, some places look at that and take it as it's my non-tenure track faculty. Some places say these are my faculty who are tenure track but are not yet who coming in ABD. And so we brought in a bunch of ABDs at very high levels. So the ABD, so they're really not that different than anybody else. In fact, we bring in some high ones. So I think it's really hard to make that much. With the AAUP, in fact, last year when I showed you guys, I didn't even show you this category because the data was kind of funky. So it is.
Because if you drop UNC, the average,
change.
I think, is without UO is 41.
Yeah, but this still is not. That's still not a good number.
Yeah, right. No.
And you could use the problem with using medians. It's hard to use medians with 9. That's why if you have if you have 30, that's why means. These are means. So. When this average, I don't know if you guys know this, the word average is mean. If I use median, I actually would have used the word median. Imagine that. But the median is the middle one. It's when you only have 7, the median is the 4th one, so it's hard. I can't eyeball it and see. Let Excel do all the work. Someone else had a hand up in the middle. No? Okay, so yeah, and so it's still behind, but not as badly. So this tells you, again, the good news, I think, is here. The bad news is here. Now, let's talk about enrollment. Now, let's bring it all the way back to what Nathan brought up earlier. Let's talk about enrollment. It looks better here. All right. These are fall enrollment numbers coming from the Office of Institutional Research. The last bar, it's 24,591 was the unofficial fall number. It has to be officially certified by the powers that be at the system office, but that's what it was according. The data shows us right now. Last time was 24,591, and from what I'm told, the lack of a big increase from 11 to 12, there are significant space. You guys are actually facing dorm and classroom constraints that make increasing enrollment much more difficult. But you can see over the last from 4 to 5 to 6 to 7, pretty flat. But then we've had significant increases in enrollment over the last several years. Now we're going to combine. Now we're really going to see what's going on with enrollment, and that's the out-of-state game that they've been playing. Now I only have 3 years of data because that's all that was up there. They only had 3 years where they gave 10, 11, and 12. And fall 12, so that's what we're sitting with right now. This is the student body that's roughly currently here. So I've got Oregon, non-Oregon total. There's a 24,591. You could see the decline in the percentage of the students that come from Oregon, from 56.7 to 54.6 to 52.5. The out-of-state going up roughly 2% a year. Where are they coming from? California. You could see Washington, not really. Foreign country, yes, significant increases. Other states, not really. So there's been a definitive movement to increase enrollment from California and from overseas. So this number here tells me that in fall 12, 19.4% of the students here were from the state of California. And you could see it was 17% just 2 years ago. The foreign country's gone from 7.7 to 10.8. This does not happen by accident. This is not, and I think someone reported to me earlier today, the provost said this just sort of blindsided us. That doesn't, they have too much control over admissions for that to blindside them. This is a definitive strategy that they've had here. And Scott had talked to me about this and said a lot of you guys had this conjecture, and these increases in the out-of-state percentage is true. But what's even more compelling to me is the ratio between the undergraduate non-resident tuition and fees versus resident. It's typical at a flagship like this to have a 3-to-1 type of ratio. That's about what it is at University of Michigan. The out-of-state tuition versus the in-state. But what's surprising to me here is that the ratio declined over time so that out-of-state is more attractive. They're actually making the out-of-state price more attractive. It leads to several questions. First of all, are they leaving money on the table? What I mean by that, if they would have left this ratio at 319 instead of 301, this number would be at least several $100s higher, times 10,000 students. We're talking a lot of money. Is it possible they're leaving a lot of money on the table? Secondly, is there a definitive strategy to attract out-of-state students using price by saying to these out-of-state students, look, our out-of-state price is not that bad compared to, let's say, as a Californian, if you wanted to go to the University of Washington or if you wanted to go to the University of Arizona, for example, places that I think some of those students may be considering in going. But still, this doesn't happen in a vacuum. They know what they're doing here. It's all part of, now what they would answer is, we have to do this. Why do we have to do this? Remember that chart with the state being flattish, and then we have to do this because of what the state's doing to us. So we have no choice but to do this. But what it has done is certainly helped increase overall tuition revenue, as we'll see. And so what I have here is the annual change in tuition revenue, and there's 3 factors that go into it here. The enrollment change, the change in resident tuition, and the change in non-resident tuition. When I usually do this, if Scott did not get on me to do this, I would have not had separate columns here. I just would have had this column here. I wouldn't have had this column. But look what I would be missing. Look at the change in tuition and fees in the state versus out of state. In-state, out of state. In-state the same. So they have increased tuition much less over the last 4 years for out-of-state students than they have for in-state students. And what it's led to, when you combine this mix with these increases in enrollment, you get double-digit percentage increases in tuition revenue. Now, this question mark here is not going to be as robust. This one here, 0.6%, definitely not the same as those increases. These are a little lower. This is going to be in the single digits. This increase is going to be in the single digits. However, the state appropriation is not going down. In fact, the state appropriation is going up a couple of percent. So we're still going to see a nice increase in total revenue. At the very last row, we see over the longer time period, of the 8-year time period, enrollment up 21, in-state tuition up 51, out-of-state up 44, tuition revenue up 89%. So it's pretty healthy. A couple of things on class size. This comes from the common data set, which is presented to the federal government. What this says is how many sections have between 2 and 9 students? How many have between 10 and 19? The class that was in here before was probably in here. Is that number of students? I'm guessing was probably, but I don't think it was definitely not full. So it was either here or here. And so I looked at the 2 out years. These are the 2 out years that they had on the website. That's why I'm using these years, the most recent and the most far away. And you can see the number of sections has gone up, but there's been an increase in the bigger sections, a decrease in these, but a big decrease here too. So I think in general, I think there's been a slight increase in class size. This is the percentage of classes that have more than 100 students. You can see that's gone up. The percentage that have only a few number of students has gone down. So I think there's been I would say there's a subtle shift in class size, but from what you guys tell me and what the students say is that it's not fun at all. But to me, the reason why there are students sitting in the aisles is not necessarily this, it's this. It's the hiring issue, and these are the last 2 slides I got. It's the hiring issue. I have here, again, I'm using the full 05 as the the furthest away that they reported on the website. Full 05, full-time faculty, then full 10, full 11, full 12. Then part-time faculty, full-time administrators. I don't know what a part-time administrator is. Graduate assistants, classified, student employees. And so what I have here is I have 3 percentage changes. The 7-year change, a 2-year change, and a 1-year change. And in the last year, faculty went up 6%, full-time, part-time only 3, administrators up only 3, enrollment up 1. And so not as bad. Again, this is from fall 11 to fall 12. So these are people, this is as current as you can get. And if you look over a longer time series, which I think is more relevant, faculty going up 25, administrators going up 38. That is the problem. Even though we had a slight positive trend here, there was too much administrative hiring in the years prior. There are just too many administrators that have been hired here. The reason your classes aren't where the class sizes and the kids are sitting in the hall, sitting in the aisles, is there's just not enough students. Look at this change over the 7-year period. There's a percentage change in faculty, and here's a percentage change in full-time administrators and part-time administrators. The biggest change, of course, is in part-time faculty. And you guys, again, you know all of this. All of you guys know this, but here it is for you to see explicitly. And this is why your class sizes, that's why the students are not getting the classes they need. There's not enough faculty at this university, given the enrollment you have. And to me, it's not just enough, there's not enough sections being offered. When you have kids sitting in aisles, it means there's not enough choice, not enough sections. And the way you get more sections is you hire more faculty. And they clearly have the resources to do so. But what they've done instead, I think, is hired more administrators than faculty. So, all right, that's all I got, if you could believe it. And I finished 8 minutes early. And I certainly would address any questions. Yes?
I got just one observation or hypothesis about that ratio of out-of-state versus in-state tuition. One of the things that's happened is that fees have increased at a faster rate than tuition, but the fees are flat. It is out-of-state and in-state pay the same fees. They pay differential rates on tuition. So as fees become a larger part of what you pay, it's going to flatten out that
Sure.
ratio.
It would do that, and we've seen that. But they're reporting. I don't know if they're reporting. No, I don't know. I'm trying to see if I could tease out I don't know if I could tease out the fees. Usually you're able to, but here I don't think I think they did the math for me. They nicely put it together, if you could believe that. And these are the required fees. It's not like a lot of courses have separate fees. That's not included in any of this. These are just the fees that they have to pay for.
Any student on campus will tell you the required fees have gone up.
What do they have fees for? Do they have a technology fee or they don't have one?
Yeah, I can't remember.
None of you guys got kids who go to school here?
Our students pay over $100 sometimes for a lot of their classes.
Yeah, I mean, the kids are all paying, they pay, but what is there a general fee? Is there a fee for athletics? Is there a fee for a whole bunch of fees? And I'm sure they're thrilled to be paying. Anything else? Yes?
Faculty salary numbers, comparing us to other institutions, are those ever adjusted for different cost of living numbers for those areas? Like you mentioned earlier that Oregon is 35th in terms of taxation.
No, we certainly, in bargaining at my Lane University, Eastern Michigan, we're in Ypsilanti. If you know your Michigan geography, we're pretty close to Ann Arbor. Our comparable schools are in the middle of nowhere: Central Michigan and Mount Pleasant, Western Michigan and Kalamazoo. So what we do is we adjust the salaries based on cost of living. The administration looks at that and says, "We don't care. You chose to live here. Tough." It's something you want to do to make yourself more depressed. I have not found it to be all that persuasive to the other side, because the other side says, "Well, we chose to live here. We all chose to live in this." Because I think if you compare some of these places, Eugene's probably more expensive than some of these places to live. Less expensive than some, but more expensive than others. Iowa is, I think you can get a house of $7 in Iowa. I've been to Iowa, I could say that. Many times. And Indiana, if you've been to Bloomington, you guys been to Bloomington, Indiana? Boulder's not expensive either. So it's more expensive here than Indiana, Boulder, and Iowa, no doubt about it. Even in Charlottesville, you guys been to Charlottesville? University of Virginia? It's much less expensive than.
I mean, the issue isn't that people choose to live somewhere. You go on the market, you go where you get the job.
I of course agree with that. The administration will counter with, if you try bring, I think to make yourselves even more depressed, bring cost of living data into it. It's not that hard to find the CPIU data for the different, and so then you adjust them and you get more depressed. My advice here is that there should be some sort of plan to move the salaries here as an AAU school, to move the salaries at least toward the bottom quarter of those schools. Wouldn't that be, that to me is what a goal that you guys should have, and it's a realistic goal that you should have. I'm not saying it's achievable right away in the first contract, but it's something that you should consider trying to achieve. Yes?
I just want to point out that there was a plan. Okay, there was a plan. The plan was approved by the administration. It was a three-step plan, at least for a tenured faculty member. The raise that you're talking about in 2011 was the first step in that. What I find interesting from the data is the fact that there's plenty of money to implement the other two parts of that right now. Okay, so we're not talking about the fact that there isn't a plan, and we're not talking about the fact that there isn't money. There's just not an interest. And that's a very different kind of issue.
But the plan as implemented doesn't seem like it was implemented fairly across.
Well, one can argue about all of that, but I'm just saying there was a plan. It was organized. Okay, it may have been unfair to some people, and I agree with that. However, I'm just saying the plan was to raise salaries
To somewhere in the.
for everybody, so that they would be at the 100% level of the AAU, our AAU comparators. And
Which is a
the first
subset of
raise
the 34?
It was a huge raise, and it was going to be done in 3 steps.
And that's the only, you can't expect to move the kind of movement in once. It can't happen in one time. It has to be gradually over time. You can't, there's no way you could have a plan to move from 112 to 120. It just doesn't, the world doesn't work that way. It just doesn't happen that way. I mean, it'd be nice. Yeah, everyone gets a $10,000 raise. Well, that's just not the way it's going to happen. It's going to have to be a plan that's phased in over time. Yes?
Because you don't have adjuncts on there, and I don't know what the average is for adjuncts, but that's enough.
The AAUP salary survey does not have the adjunct rate. I think it's something that this bargaining unit should have. My guess is that the adjunct pay, we have the pay. I think the bargaining unit probably has the pay for the adjuncts. Trying to get comparable data, I think, is something that I'm sure they're doing. My guess is that it would not be very favorable toward the adjuncts here. And I don't mean that in a bad way. I just don't think it would be. I don't think they'd be very pleased with what they found. But that they need to report. I think it needs to be reported, and it needs to be bargained over. That's, again, my belief. And hopefully that's being worked on. Yes?
Devil's advocate here. So if an opponent of this basic line, which is that the university has plenty of reserves and should be spending some of them to raise frontline salaries to move us up this ranking, someone who opposed that, aka an administrator, using this same data, what would their main arguments be?
Their arguments would be the reason we have those reserves is because we've been strong stewards of your money, we've been prudent, we've been fiscally conservative, and that's how we've gotten the strong reserves we've gotten. We can't all of a sudden change that course now. My response to that would be, you're not committing to the core mission. There's too many of you. You could find the money if you just had less administrators, and giving 3.5% raises to a group that's making this much really diverts resources away from people who are right in the front lines with our students, and that's where the resources should go. Yes?
Just a little question. A lot of our administrators teach one class. Are they in the instructional category, or are they in the administration?
That's a good question. Even if they teach one class, if their job title is associate dean or dean, they should not be in the instruction category. But if they're just an adjunct teaching one class, they'll be in instruction. But if they're a dean who teaches one class, they should be in academic support. They're full salary. That technically what they could do is take.
They can't play with that.
No, they're not supposed to. But I think, who's watching? So I think there's a lot of leeway as to what goes where. I think one of the, in terms of counter arguments, again, devil's advocate, they would say we categorize things differently here than other places do. And the answer to that is, well, here are the rules. Tell me which ones you don't follow and which ones you do. That's the way to implement that. Yes?
Is this salaries or it's just salaries?
Just salary. This is, obviously they have some stuff on total comp. The problem with total comp is, I think what gets costed out sometimes is not always equal across schools. The benefits data is quirky. That's why, to me, it's always easier to compare salaries to salaries and not add back. But AAUP Salary Survey does have another category, which is total compensation, which includes all the benefits.
Let's say as a matter of record, very low-paying NTTFs, their benefits are often around 45% of total salary.
Well, that's because the denominator is smaller. And that's including the full health care benefit, which is very expensive, which is not part, and a point we'll make, healthcare, the cost of healthcare should not be part of any salary negotiations, because if you get a raise, it doesn't change what your healthcare is. The only thing that changes is your retirement, is the university's retirement contribution and the payroll taxes they have to pay, but not your health. Your healthcare is the same whether you get a 5% raise or not. Yes?
That's often that's an argument that I've heard in response, actually, is, well, yes, we know your salaries are lower than the comparators, but your benefits are better. So
well,
why are you complaining?
Let me say this about that. First of all, that's not true. Last time I was here, I had some benefit data on what it costs them for retirement benefits and what it costs for health care, and they're not any better. What do you guys pay for retirement? Don't you guys put money into your retirement?
No, they actually pay the employee portion.
Which is how much?
Of the retirement.
Depends on the year.
The total was 11%.
Yeah, there's 3 tiers.
It's tiers depending. So it goes anywhere from single digits to mid double digits?
The other issue is that there's 2 plans. In the PERS plan, the state of Oregon was told, starting in the early 80s, to get rid of the PERS plan by every consulting firm they hired, because I worked for 3 of the firms, and Oregon was our client for each of them, and they never got rid of it. And now PERS is, this horrible
albatross.
I mean, it's worse than, it was an albatross in the 90s. It's now,
before it was cool to be an albatross,
to the bottom of the ocean. And the other choice is to go with the TIA prep for that. This is just, for the tenure track faculty. And of that, right, their portion was, the 5%, and the employee portion I think was 6%, or vice versa. But it's at about 11%. And the reason for the big upswing in the PERS and the TIA prep had to do with, I think, in the 70s, the salaries were so low then that the state made up for it in benefits, right? Saying that your salaries are low, so this is how we'll make up for it. But now what's happened, obviously, as you can see, over years and years, we haven't, for those of us in TIA craft, we obviously will not accumulate, right, at the rate that we would had we been anywhere else.
You'd be better off. Yeah, there's no doubt about it. I could tell you in terms of, University of Michigan, the faculty don't pay anything. The university pays 12, so whatever that's worth. I doubt your benefits are better. In fact, I'd predict they're not.
No, of course not.
So, all right, thank you guys very much. Appreciate it.